The secrets of loans. Loans, they are everywhere. They fuel economies, shape personal lives, and underpin the financial world in ways most people never notice. Almost everyone has interacted with a loan, whether it's a mortgage, a personal loan, a student loan, or a business line of credit. How many truly understand what loans really are and the forces that control them? At first glance, a loan seems simple. You borrow money, pay it back with interest, and move on. But beneath this seemingly straightforward transaction lies a hidden architecture of rules, incentives, and systems designed to generate profit and influence behavior. The world of loans is complex, often opaque, and tightly interwoven with global finance. Consider this. Banks don't just lend money, they create it. When a bank issues a loan, it's not moving cash from one account to another. In modern banking, a loan actually creates new money, expanding the supply in ways that most people never realize. This hidden process powers economies, yet carries risks that can destabilize entire financial systems. Interest rates, repayment schedules, collateral, credit scores, they are not random. They are carefully designed levers, influencing borrowers' behavior and managing risk in a system where a single misstep can ripple across continents. Understanding loans is not just about personal finance. It is about understanding power, control, and the very fabric of modern economies. Today, we dive deep into the secrets of loans, not just how they work, but why they exist, who benefits, and how they have shaped the course of human history. This is the story of money, power, and debt, the hidden forces behind every loan you've ever taken. At the heart of every loan is a simple promise. The borrower receives money now and agrees to pay it back later, usually with interest. But what seems simple on the surface is actually a highly sophisticated system that powers the global economy. When a bank approves a loan, it does something extraordinary. Unlike a physical exchange of cash, the bank creates new money digitally. The moment the loan is deposited into your account, it increases the total money supply. This is not borrowed from someone else's deposit. It is money that did not exist before. Economists call this the magic of fractional reserve banking, and it's one of the most misunderstood aspects of modern finance. But money creation is only one piece of the puzzle. Banks need to ensure they get their money back, plus interest. That's where credit worthiness comes in. Lenders evaluate borrowers through scores, histories, income, and behavior patterns. Every detail, from payment history to spending habits, becomes part of a vast algorithmic risk assessment. The better the score, the cheaper the loan. The worse it is, the higher the interest rate. Interest itself is a powerful mechanism. It is more than profit for the bank. It's a control tool. Small variations in interest rates influence entire economies. Low rates encourage borrowing, spending, and investment. High rates slow consumption, reduce inflation, and stabilize markets. Every decision about interest is both a financial strategy and a policy tool, affecting millions of people's lives without them ever realizing it. Collateral adds another layer. By requiring assets like homes, cars, or business equipment, banks reduce their risk. But collateral also transforms loans into instruments of power. If a borrower defaults, the lender can claim the asset, creating a tangible consequence that reinforces financial discipline. And yet these mechanisms are double-edged. Excessive leverage, risky lending, or misjudged collateral values have triggered some of history's largest financial crises. Understanding loans is not just about numbers on a spreadsheet. It's about risk, control, and influence. Behind every loan lies a system that governs economic behavior, rewards compliance, and punishes miscalculation.
The hidden history of loans. Loans are not a modern invention. They have existed for thousands of years, shaping civilizations and economies in ways few realize. From ancient Mesopotamia to modern Wall Street, the story of lending is a story of power, trust, and survival. In Mesopotamia, One of the earliest known financial systems involved loans of grain and silver. Farmers and traders borrowed resources to sow crops or fund trade expeditions. Failure to repay could lead to harsh penalties, including debt slavery. Lending was not just economic, it was a tool of social control. The elite controlled access to credit, shaping wealth and power for centuries. Fast forward to medieval Europe. Moneylenders emerged as central figures in towns and cities. With the church prohibiting usury or charging excessive interest, lenders had to operate creatively. They devised contracts, collateral agreements, and partnerships that allowed trade and commerce to flourish despite moral restrictions. Loans became instruments of innovation, enabling merchants to fund voyages, invent tools, and expand markets far beyond local towns. The Industrial Revolution accelerated the importance of loans. Factories, railways, and urban development required vast amounts of capital. Banks stepped in, creating systems of debt that powered unprecedented economic growth. But growth came with risk. Defaults, panics, and crashes were frequent, demonstrating that loans were both engines of progress and catalysts for economic instability. In modern times, loans have evolved into highly structured, complex instruments. Mortgages, credit cards, student loans, and corporate debt form an interconnected web that drives economies worldwide. Governments, banks, and corporations are bound by these systems, making loans not just a financial tool, but a structural pillar of modern society. Yet despite centuries of evolution, the essence of lending remains the same. Loans are agreements of trust, reinforced by rules, collateral, and incentives. They are a reflection of human ambition, risk-taking, and the ever-present tension between opportunity and obligation. The impact of loans today. In the modern world, loans touch nearly every aspect of life. From buying a home to starting a business, loans enable opportunities that would otherwise be out of reach. They allow families to access education, entrepreneurs to launch ventures, and governments to fund infrastructure. At their best, loans are engines of growth, opportunity, and progress. But loans carry a shadow. When mismanaged, they can trap individuals in cycles of debt that last years, even decades. High interest rates, hidden fees, and predatory lending practices can turn opportunities into burdens. Credit cards and payday loans, for instance, promise quick access to cash, but they often spiral into long-term financial strain. The consequences are not just personal, they ripple across communities and entire economies. On a larger scale, corporate and government loans shape markets and influence geopolitics. Nations borrow to fund development, stabilize economies, or invest in infrastructure. Corporations leverage debt to expand operations, acquire competitors, or finance innovation. These systems can create prosperity, but over-leveraging has triggered some of the most severe financial crises in history, from the Great Depression to the 2008 global recession. Understanding loans is therefore not just about personal finance. It is about power, responsibility, and foresight. It is about recognizing that every loan is part of a vast network of incentives, obligations, and consequences that extend far beyond individual borrowers. The decision to borrow, the structure of interest, and the repayment schedule are all threads in the complex fabric of economic stability. Loans are in essence a reflection of human ambition and risk. They enable growth and innovation, but they also carry the potential for control and exploitation. Those who understand the hidden rules of lending, how money is created, how interest shapes behavior, and how risk is assessed, hold an advantage. They navigate the financial system with awareness rather than naivety. Conclusion. Closing reflection. The secrets of loans reveal more than just financial mechanics. They uncover the intricate dance between opportunity and obligation, power and responsibility, and risk and reward. Loans are tools, but they are also instruments of influence, shaping behavior, economies, and societies. Every loan carries a story. Behind the numbers are decisions that affect lives, communities, and nations. By understanding these hidden forces, we can make wiser choices, avoid traps, and harness loans as instruments of growth rather than burdens. In the end, loans are more than money. They are a reflection of trust, foresight, and human ambition. They are both a promise and a responsibility, a secret architecture underpinning the modern world. And the more we understand that architecture, the better we can navigate a system that governs not just our finances, but our future.